were debating with each other. Chatur Sen is a new and young investor, while Mahin Prasad is a seasoned player. Chatur asked Mahin about his portfolio. Mahin told him that his portfolio has good shares like HUL and Maruti that have given good returns in the last 1 year, while some shares in his portfolio did not perform well. Chatur asked him why is he buying such expensive shares. He can simply buy low-cost shares that cost around 100 to 200 rupees and then sell them when the price goes up. Chatur added that's what he does. Mahin cautioned him that this can prove costly. On hearing this, Chatur got confused. Mahin started explaining.
Who does not like low-cost items? I guess almost every Indian. Hence, you see a huge crowd during the festival sale. Maybe this mentality is the reason that Indian retail investors have a higher shareholding in companies that are of lower cost. Investors generally think that they won't have to invest a lot in buying those shares.
For example, if we look at the aviation sector, SpiceJet share is trading around 33 rupees, meaning this is a low-cost share. Hence, retail investors have 39.4% shareholding in this company. On the other hand, if we look at Indigo, its share is around 1,862 rupees. However, retail investors account for just 1.98% of the shareholding in this company. It is clearly visible that retail investors prefer the company whose shares are available at a low cost. A similar trend is available if we compare Maruti and Tata Motors from the auto sector or Star Cement and Ultratech in the cement sector, etc.
So now comes the real question. Is low-cost share good? Do investors really get good returns when they invest in these low-cost shares? And what does data say about it? So the answer to all these questions is no. There is no relation between returns on share and their price.
See, if we analyze stock with respect to the price, so most of the times the retail investors looks towards the smaller prices of the shares. They attract because they understand that they can buy more shares with the same amount. But while analyzing the companies of the same sector, let's say, and one is trading at a high price and one is trading at a low price kind of things, we don't see the price, we see the value. Where is more value left to the investor? In sense, we try to analyze the company with respect to their profitability, with respect to their efficiency, with respect to their, you can say, the investment in the growth assets in the coming future, with respect to the capex that the company can do it successfully. So all these things we consider irrespective of the price. Then we go to the valuation of the company. Then we see which company is giving you more value.
Looking at the return of low-price shares like SpiceJet, Vodafone Idea, Star Cement will give us insight that they have performed poorly in 1 year as well as 5 years. They gave negative return in the range of 7.5% to 86%. A negative return basically means their share price has fallen. SpiceJet has given minus 74% return in the last 5 years. Currently, Vodafone Idea share is around 6.6 rupees. But in 5 years, it has given 86.4% negative return. On the other hand, if we look at the shares that trade at a high price, then they have given pretty good returns. Indigo's share has gone up by 47% in the last 5 years. The current price of Reliance Industries is 2,288 rupees. However, in the last 5 years, it has gone up by 157%. The current market price of TCS is 3,286 rupees. It has given 133% return in the last 5 years.
These examples clearly indicate that there is no relation between the price of a share and its return. Now, investors must be thinking that how to choose different shares. So, experts suggest choosing shares on the basis of various parameters and valuation ratios instead of their price.
So while looking at the prospect, first of all, we look at the company's prospect, future prospect, or the sectoral future prospects. We analyze those things and we try to look at the companies which are well positioned to garner or to to take the benefits of the expanding sectors, and try to look in the efficiency level of the management, like you can say inventory turnover ratio, asset turnover ratio, and then we go to look at the profitability ratio, whether the business which the company is doing in the past, whether they are able to garner efficient kind of things like return on equity, return on capital employed, return on invested capital. If these are superior compared to their peers, then those are the companies which we should look for. And after that, try to look at the valuation. So whenever you are investing in a smaller price company, we should look at least in greater details about those things, because sometimes we find multi-bagger stocks in the smaller companies, but again with a lesser market cap and larger opportunity size that those management and the company can do with in the coming future. So these are the things I think one should look for the investing in smaller cap companies or smaller price companies basically.
The first important thing is that whenever you invest in some company's share, then look at its balance sheet. In the balance sheet, start with debt levels of the company. If it has debt, then look at its debt to equity ratio. If debt to equity ratio is less than 2, then it is considered as good. Ratio above that is a red flag. Do also look at the debt paying capability. This is assessed by interest coverage ratio or debt service ratio. Debt service coverage ratio basically tells how comfortably the company can pay its cash. Besides this, you also need to look at promoter holding of the company. Have they pledged any shares? Third, you have to look at industry structure. Is it cyclical or not? Also look at the business model of the company. The fourth thing to look at is the trend of operating margins of the company. Are they improving, stable, or declining? The fifth important thing is to look at the valuation ratios of the company. How are the valuations in comparison to its peers?
Overall, we can say that buying a share is not like buying other items from the market. There you can bargain and get cheaper deal. But however, when you invest in a company, you are actually becoming an owner of it. So invest in a share only after analyzing it on all the parameters. If a company is strong, there is good growth prospects in the company, only then you can invest in it even if share price is quite high. Instead of buying low priced shares, choose the ones that have strong fundamentals and are available at attractive valuations.